Hey, good morning. It's Scotty from the Gifford Group once again, and today we're back with another calculator. I know this has been seem like I'm a calculator building fool lately, but today I wanted to talk about DCRS loans, and because of it is a feature that we offer for investors that are looking to get into a property. Some of the cool things about DCRS is that it allows you to really qualify not based on your income or based on your debt to income ratios. Your credit score is still important, but it allows you to get into, I say, a rental property or investment property that you are trying to get in without having to use your income to qualify. So let's go check out the calculator. But the calculator can be found right now under our Apply Now page under the Home Resources tab. So, and it's a lot of great information about first-time home buyers and FHA loans and VA loans and jumbo loans and just a lot of information on there. But if you scroll down a little bit, about midway down, I'll put a link directly to it in here in the video that you can link to. Um, and this calculator might change a few things, some of the colors or wordings or something like that, but I'll put it here. I'm always updating the calculators to make sure that make it easier to use. But the overall basics should stay the same. So on the left side, like say on the phone or the tablet, will look a little differently because you just don't have much screen space. But on the computer is always the best to kind of do these calculations on. But I think realistically, because you can kind of see it all one screen. I'm trying to make this as easy as possible, and it is available on the phone and tablet if need be. Just might do a little more scrolling. Um, so the DCRS loans, you're usually looking for a ratio over one to get qualified. We do have some loans with ability to qualify when it's less than one, but you're going to usually put more down. So to get the best use of this kind of loan, right, which is the debt servicing coverage ratio loan, you're going to want to have a credit score above 700, at least probably about a 680. You need to have owned a home in the last 12 months. And they have different programs for seasoned investors or first time investors. Now, I personally have used a DCRS loan myself in the past to buy a home, and like people didn't really understand it. So it's like, how can you do that? You don't have the income, or you already have three other properties. How can you qualify? And you have a personal residence. How can you qualify for this? And that the good part is that it's not qualifying based on me; it's based on the property. So really, realistically, if I can find a property that cash flows, and it doesn't even really necessarily have to cash flow per se after all my other expenses. It just needs to make sense from uh, a debt service ratio perspective. Like, does the rent cover all my expenses and the loan, right? So, and I'll explain that a little bit more. But here's let's just start off with an example on the calculator so that you can walk through yourself. And like I said, once again, it's on the giffordgroup.net/apply now, and I'll have a link directly to it. So you're just going to put in your purchase price, and you can put in your down payment. So the thing that really matters is the actual loan amount, but sometimes I'd make it simpler. I could have just put in just like, hey, what's this based off the loan amount? But I like to see, because like I say, we can't do more than 80% loan to value on most of these. So maybe every once in a while, if you have really good credit, certain times they, like in the past, you could do 15, but I think right now most of them are going to be at 20%, if not 25% down. But like I say, if you're above 700 credit score, you should be able to probably get away with on a purchase and a refi and a rate and term refi. On a cash out, you are going to be limited to probably 75%. So if you have property that has enough equity in it already, then you can, if you could do up to 75% on a cash out if you're above 700. So, but let's stick to a purchase in this situation. So let's say we found a property, say for 230, right? And these numbers are going to update automatically anytime you change anything. So, but we're going to put let's put okay. So we're doing 20% down. So we put down $46,000 here, right? And now we have a mortgage of 148. And now we have some repair costs we can include in there, and then we have our closing costs. You can adjust those. And they're probably, there's going to be points, and to get the better rates, you're going to have to pay more points to buy it down the rate. So, rates right now are probably around 7. So probably that's for owner occupied. So for this type of loan, they're going to be a little bit higher. Maybe you can get in the eights, maybe a little higher, depending on, obviously, I don't know when you're going to be watching this video, but rates obviously fluctuate all the time. So, keep abreast of that kind of situation. You can always reach out to us, if you want to figure out what the rates would be for you. Obviously, I would want to have you get approved first before you go out and just try to get this house and then try, well, I thought I could get 7%. No. So, so we have an interest rate. We have a 30-year mortgage. Now you can do 15 or whatever, but most people if you're buying an investment property, probably going to be a 30-year mortgage. And then you're going to put in your rent. Now your rent's really going to be the other big factor that's in here. So let's say we can get 2250 for rents on this one. And then, so I have the monthly property bills here. It's really just a breakdown of the property taxes, HOA, and insurance, and any other bills you might pay. So I give you the option. You can just put it in as one number, or you can break it down in individual numbers here. So, all these are adjustable however you want. So you put in your property taxes, and this is monthly because it's going to be over a 12-month period we're looking at here. So we could say, okay, our taxes are $400 a month. Maybe our HOA is only $25 a month. And then the insurance, let's say that's $235 a month, and we don't have to pay any water bills. So in Texas, usually tenants are responsible for water unless you're in like a multifamily situation. If it's a single family home, in this situation we're talking about here, probably not going to be paying that, so we can just leave that off. So you can see, so that's really all the numbers we kind of need to figure out what our DCRS coverage is. And I kind of made this little chart over here. Like, okay, red, we're probably couldn't do the loan. Yellow, we're good. Really, it'd be better if you can get up into 1.25 range or 1.25 range. It's better for you, and the easier it is going to be get you to get the loan. But realistically, you just need to be over 1. So in this situation, hey, we're over 1. So what this did was, it took the loan amount at the interest rate and calculated our mortgage. And then it took all of our property taxes, HOA, and insurance, and it included those. If you scroll down to, you can see that it tells us what our NOI is, right? So, and our NOI is our net operating income. These are our gross rents for the year. These are our total cost of the property, which is the purchase price, the loan, the closing costs, repairs, to get in the remodeling cost, or remodeling and down payment to get in there. So this tells you, hey, your return on investment. Basically, this is going to be your NOI over your total cost. So it's not a calculation a lot of people use for real estate. A lot of people use more of a cash on cash return. So I did include that, and also did include a cap rate calculation because some people look at cap rates. So, and the cap rate's going to realistically, it's going to be based on what's your NOI, your net operating income over the current market value. So I included the ability to put ARV in here, or after repair value. So assuming you're purchasing the property and then doing some repairs, then driving up the value, that would actually tell you what your cap rate is based on your rents over the actual value of the property, not just the purchase price. Because if you are doing repairs, if you aren't doing any repairs, if you just do that to 0, I think that's going to go away. I think I took that a way to put in so it's not going to calculate a cap rate for you. But if you just put in $500 or whatever, so I can, if someone says, hey, I really want to calculate cap rate all the time, I can just calculate do that. But I just thought I want you to put in your own ARV or your own value of the property, not just use the purchase price or just the purchase price plus the down payment, right? I want you to put in your own, what you think it's worth in there. So usually you're going to be probably doing some repairs. Not that you couldn't do that. Not you could just buy a property, just put in $1 and still do. So back to the DCR's calculator. So this is your total debt services, and that's really what the ratio is going to be about. So it's going to take our gross rents, right? We're taking our 2250 there, and that's going to be our 27,000 a year in rents, and it's going to be divided by our return, our operating. Our debt service ratios here. So taking the 16,000, that's how much the mortgage payment is for the year. Because it's 13 times the 12, right? So we get the 1602, and then all these other expenses are included in there, and that gives us our ratio, right? So it's our total debt service plus our monthly cost, our total rents divided by our cost of the mortgage and our cost of all the other bills associated with the home. And so I did include a cash on cash return calculator in here too, because I thought it'd be useful. Like it's usually like in real estate, just going by one number sometimes doesn't make sense. I wanted to include more information as possible. Sometimes maybe it's overkill, but I thought, hey, you're already inputting the numbers for this. I can easily calculate this too. So this is your total cost, for the mortgage and your bills over here. So, and then you're making 2250. So you go, okay, yeah, I'm making almost $240 a month cash flow, positive cash flow. All right, boom, right? So you can buy this property. You can get this loan using not even your own. I mean, you do need to have reserves on the DCRS loan, and you do need to have money that's seasoned in the account. But you don't really have to base it on your actual income or proof of income for the property, right? So we probably will ask for bank statements to see that you do have the money in the reserves, but or whatever you want to show us as far as income. But you could buy a property here. You could buy this property, this $230,000 property. You got to put your total cost to acquire the property over here, $54,000. So you do need some cash, obviously, when you're buying. I know a lot of people think about, well, I'm gonna get it. I want to buy real estate with zero down. I mean, realistically, unless you're doing some kind of sub two, and even then, you're probably paying closing costs and realtor fees for the. There's not a lot of $0 deals out there. This is like a realistic example of buying a property, getting a mortgage, putting 20% down, having a higher interest rate in the environment we are in, paying the mortgage, paying the property taxes, the HOA insurance, and still making a little cash flow on this. Right now your cash on cash return is 5%, which is that the best? Probably not. Probably would want to get closer to 15 because we haven't included some other things. And so in this calculator, I didn't include the ability to include vacancy, capital expenditures, and property management. So, and obviously, I made this as you can vary these. So if you say, hey, well, I'm going to manage it myself, so there's no property manager, and single family residents have a lower vacancy rate. But if you wanted to include that, usually most of my properties I've rented out and I bought them and I've had the renter lined up before I even really closed on my loan. But you can count for vacancies in there, and you can count for future repairs. So if you count for your expenses in the future, just to make sure, hey, does this property still cash flow me? Is this still a good rate of return? I mean, I probably, at this point, I'd be like, okay, well, I need to either get the rents higher or I need to get the purchase price lower at this point for the cash flow standpoint to make sense. And say, if we go back to the seller and go, okay, well, I really need to buy your property. Let's say we can get them down to 215. The interest rates are high and they're willing to work with us. And maybe we can get. We're still going to put. Let's put down 43. There we go. So we're at 80% there. And now, so hey, it's a little bit better. Cash flow is a little better now. We're up to 4% after accounting for some repairs and vacancy there, and then our little cash out of pocket's a little lower. So hopefully, this calculator does a lot of the work for you, and that's what I wanted to provide it for, so that you could at least look at some numbers up front, see if you kind of qualified on the property, because usually if you're an investor, you're probably looking at multiple properties, trying to make sense which one does make sense for you, and which one, how much can I offer, and then obviously, if you need to go back and renegotiate because you found stuff during your inspection period. So if you do need help, with the loan, I can help you. You can apply. I'll include a link below to our link to apply for the mortgage. And if you are in the Houston area and you are looking to purchase a property, we can definitely help you out with that. We're both, me and my partner Amber are both realtors, and we can help people, submit offers on properties if you are looking to, purchase a property as well anywhere in the Houston area. So we're here trying to educate people. Our goal is to help people make informed decisions about their real estate, not just divorce. That's our our specialty, but obviously we're all in on this. And so We do have multiple rental properties ourselves, so we have that history and we know what we're looking for. We've dealt with tenants and evictions, and I'm probably going to do another video on evictions, so look out for that in the future. So one servicing calculator and the loans and stuff like that. So it is on the giffordgroup.net. So it's going to be our blog, and you could just probably Google search, if you want to look for the debt servicing or DCRS loans and the Gifford Group, and the blog will probably come up for you. And then check out our other calculators on our website. And I thank you so much for watching, and have a great day.